$700 billion. That's how much market cap just evaporated from US technology stocks in a single trading session. And if you're sitting there thinking this is just normal market noise, I need you to pay very close attention to the next 6 minutes. Here's what I'm going to show you. The exact reason this sell-off is different, which specific tech names are triggering the cascade, and the precise playbook institutional investors are executing right now, while retail traders panic sell their positions at the worst possible time. Let's get into it. The Nasdaq composite just dropped over 2%, dragging the S&P 500 down with it. But here's what the headlines aren't telling you. This isn't random selling. This is systematic de-risking, and the fingerprints of institutional rotation are all over this move. Look at the options flow data. Put volume on the QQQ spiked to levels we haven't seen since March. The put-call ratio on mega-cap tech names crossed above 1.2, signaling that big players are actively hedging or outright betting against continued tech strength. Now stop for a second. I know what you're thinking. You're thinking maybe this is just profit-taking after a massive run-up, and you'd be partially right. The Nasdaq was up nearly 30% year-to-date before this pullback. Trees don't grow to the sky, but here's the pattern interrupt you need to hear. The VIX, the market's fear gauge, barely moved. Let me say that again. Stocks plummeted, but volatility didn't spike. That tells us this isn't panic. This is planned. Big money is calmly exiting positions. They're not scared, they're strategic. And if you're still holding your tech-heavy portfolio without a plan, you're the liquidity they're selling into. Section 2. Why tech specifically? 3 converging forces are crushing technology right now. First, the 10-year Treasury yield is climbing again. When yields rise, growth stocks suffer. It's math. Future earnings get discounted at higher rates, which compresses valuations. Tech companies that trade at 50, 60, 70 times earnings feel this pain the most. Second, semiconductor stocks are rolling over hard. Nvidia, the poster child of the AI boom, just closed below its 50-day moving average. AMD and Broadcom are showing similar weakness. When the leaders fall, the soldiers follow. Third, and this is critical, earnings revisions are flipping negative. For the first time in 4 quarters, analyst estimates for big tech are being revised downward, not upward. The AI hype is meeting reality, and reality is a harsh judge. Now here's your pattern interrupt. None of this means tech is dead. Absolutely not. But it does mean the easy money has been made, and the next phase requires precision, not blind optimism. Section 3. Where is the money going? This is where it gets interesting, because money never sits still, it just moves. Sector rotation data shows clear flows into energy, healthcare, and surprisingly, utilities. Defensive positioning is accelerating. The Utilities Select Sector ETF just hit a 52-week high, while tech is getting crushed. That's not a coincidence. Small-cap value stocks are also catching bids. The Russell 2000 Value Index is outperforming the Nasdaq by nearly 4% over the past 2 weeks. When small beats large and value beats growth, it signals a regime change. Not a crash, a rotation. And here's what the smart money knows that you might not. These rotations typically last 8 to 12 weeks. We're only in week 2. That means there's still time to reposition, but not much. Section 4. Your action plan. I don't do fear-mongering on this channel, I do strategy. So here's exactly what I'd consider if I were holding a tech-heavy portfolio right now. Step 1. Assess your concentration. If more than 40% of your portfolio is in technology, you're overexposed. Diversification isn't about chasing performance. It's about surviving long enough to capture the next cycle. Step 2. Identify your winners and trim into strength. Not sell everything. Trim. Take some profits off the table on positions that have run up 50, 100, 200%. Let the rest ride with house money. Step 3. Build a watch list for the rotation. Energy names with pricing power. Healthcare companies with strong pipelines. Dividend aristocrats that perform when growth stumbles. Step 4, and this is the most important one. Do nothing if you're a long-term investor with a 20-plus year horizon. Seriously, if you're dollar-cost averaging into index funds and you won't touch this money for decades, this noise is irrelevant. Stay the course. But if you're actively managing your portfolio, if you're within 10 years of needing this money, You cannot afford to ignore what the data is screaming right now. Final thought. Markets don't give you perfect information. They give you clues. And right now, the clues are pointing to a meaningful shift away from the tech dominance we've seen all year. The question isn't whether this rotation is happening. The data confirms it is. The question is whether you're positioned for what comes next, or whether you're going to learn this lesson the expensive way. If this breakdown gave you clarity, hit the subscribe button and turn on notifications. I drop market analysis like this multiple times per week, and in a market this volatile, being one day late on critical information can cost you thousands. I'll see you in the next one.